economics of risk and insurance. Quiet, please. But probably more appropriate title would be from healthcare to welfare. The previous lecture, I think, was on war. War is the top subject for the Republicans. They like to invade the entire world to persuade them of democracy. I'll give a lecture later in the week on the virtue or non-virtue of democracy. But the Democrats love health insurance, which is a euphemism for welfare, as you will see. So one group of people loves to ruin the rest of the world, and the other group of people loves to ruin the domestic citizenry. So I want to talk about economics of risk and insurance. Let me give you a brief explanation of how insurance functions, and then go into more detail as we go along. Any type of insurance involves the pooling of individual risks. It implies that to some of the insured, more will be paid out than what they paid in, and that to others, less will be paid out than what they paid in. Some people pay an insurance premium and nothing happens to them. Others do pay an insurance premium and something does happen to them. It is always necessary for insurance that we have a group of individuals that are pooled in a risk pool. Of utmost importance for insurance is, and I'm talking about how insurances on the free market would work. We will see that later on, that insurances in the real world are not really insurance companies. They are to a large extent welfare companies. What is important is that no one of the people who insures himself against certain contingencies, against certain risks, knows who a winner will be and who will be a loser. A winner would be the person, using now the terms as I define them, a winner would be a person who pays into the insurance and then is hit by disaster. We might not normally refer to that as a winner, but nonetheless, he actually got more out than he paid in. And a loser would be the person who paid in and nothing happens to him. Again, in normal, we would say, what a lucky guy, but in this case, he is, of course, a loser. He paid in vain and nothing happened. So very important, and I'll come back to that in a few seconds, very important is nobody knows who will be a winner and nobody knows who will be a loser. Winners and losers are distributed randomly, so to speak. And the resulting income redistribution, there's obviously an income redistribution. The winners get something and the losers only pay and get nothing. There's an income redistribution. The income redistribution is unsystematic, is unpredictable. Otherwise, if the winners or the losers could be systematically predicted, and I'll explain that in a second in more detail also, then the losers would not want to be insured or would not want to be pooled as far as their risk is concerned with winners, but with other losers. Take an example. Let's say you take out accident insurance, and you have professional football players and people like me sitting behind the desk and facing the constant risk of their chair breaking down and I myself getting severely injured. Now, if an insurance company would go about and charge us the same premium, then of course I would certainly know that I must actually subsidize the football players because the risk of theirs to contract an injury is significantly higher than my own risk. That is, in this case, we could systematically predict who will be the winner and who would be the losers. The football players would be the winners, and I would constantly be a loser. Such insurance, as we'll see in a second, such practice would not last in the market, would not last for a second. For the following reason. Because there is competition between insurance companies. Different insurance companies offer their services. And this competition defined as, I think probably Professor Di Lorenzo explained that as competition exists if there's free entry, if firms can freely enter any line of production that they want to enter. Competition between insurers would eliminate all systematic redistribution, should it somehow exist, unless, of course, people want to make a voluntary subsidy to other people. That is, if an insurance company would cover me and professional football players in the same group, then they would realize, and I would realize, that actually we should be classified into different groups. A new insurance company would, for instance, say, look, by only insuring people like Hans Hoppe and excluding professional football players, or grouping professional football players into a different group than people who sit behind a desk, we can offer a lower premium for people like me, and we would have to charge a higher premium to professional football players. And unless I'm in love with professional football players and want to support them out of the goodness of my heart, I would, of course, then go for an insurance company that would charge a lower rate. And the insurance company that misgrouped people at the beginning, that has grouped us all together, would lose all the cases that have a low risk, such as me, and maintain only those clients that fall into the high risk group, and would have to raise insurance premiums for them and follow suit with the other company and lower the rates that they charge me. Competition sees to it that all companies that misclassify people, that put you in the wrong risk groups, would be outcompeted by companies that place people correctly into the right groups, such that as a result, ultimately, there is no redistribution except random redistribution of income among various people being insured against various risks. So this competition between insurance companies would then lead to, they might initially group people in a rather rough way, and competition would then see to it, or bring about the effect that a more refined subgrouping of people will take place, with all people grouped in the same group, facing, so to speak, the same type of risk, with no possibility existing for people placed in the same group picking in advance who will win and who will lose. The premiums that charged for people placed in various groups would then reflect the genuine insurance risk. And the price differentials of various premiums would correctly reflect, so to speak, the different degree of risk faced by this group or faced by that group. And again, as in all areas, prices on the average, that is premiums paid to insurance companies, would tend to fall as a result of people always trying to reduce the cost of operation and then passing lower cost of operation onto, in the form of lower prices, onto consumers, just as in all other areas. Insurance companies then, very important to realize, the principle of it. The principle of insurance companies is, of course, discrimination. But discrimination based on group risks. The discrimination distinguishing between people falling in that group or in that group could be based on regional criteria, people living there or people living here. That can be would, for instance, for hurricane insurance, flood insurance, obviously, on the top of the mountain, you have very little risk of flood insurance, for instance. Or the discrimination could be based on biological criteria. These are women, these are men, these are children, these are elderly people. They could be on genetic information that we have about various people. These people have these types of chromosomes and others have those, and these types of genes and others have those types of genes and all the rest of it. It could be based on race. But in any case, whatever the criteria are on which people are discriminated, have, so to speak, an objective basis. The objective basis is people who fall into this group have a different group risk than people who fall into a different group. There's no arbitrary discrimination going on in insurance companies. So now I want to come to the question, what sort of contingencies are insurable and what contingencies are not insurable? What sort of surprises that can happen to us are surprises against which one can take out insurance? And what sort of surprises exist against which one cannot insure oneself, but has to take care of individually, through individual precautions, for instance? Or put it differently, does this subgrouping, people usually classified in large groups and then in smaller groups, does this subgrouping ever come to an end? Now, both Knight, that I mentioned before, and also Mises say that this subgrouping comes to a stopping point. That there are certain things, certain surprises against which we cannot insure ourselves at all. Now, in order for any non-redistributive risk pooling or grouping to be possible, the following condition must be fulfilled. And I give you a quote of Mises. This is Mises' definition of what he calls class probability, and that coincides with what Knight calls risks as compared to uncertainty. They both make a distinction. On the one hand, risk, and Mises refers to that as class probability, and on the other hand, uncertainty, and Mises refers to this as case probability. So for something to be insurable, the following condition must hold. That is the insurer and also the insuring company, must assume to know, with regard to the risk concerned, everything about the behavior of a whole class or group of events, but about the singular event or the singular risk, we know nothing but that they are elements of this class. Let me repeat again. We know everything about the frequency of certain occurrences for the group as a whole, but we do know nothing about each individual member of the group, the likelihood of the risk, except that he is a member of this group about which we know everything there is to know about the frequency of certain occurrences. Let me just give you, again, a further quote from Mises to clarify this. Let us assume that 10 tickets, each bearing the name of a different man, are put in a box. One ticket will be drawn, and the man whose name it bears will be liable to pay $100. Then an insurer can promise the loser, that is the person who has to pay $100 or to whom $100 have to be paid, then insurer can promise the loser full indemnification if he is in a position to insure each of the 10 for a premium of $10. He will collect $100, each pays $10, and will have to pay the same amount to one of the 10 once this event occurs. But if he were to insure only one of them at a rate fixed by the calculus, he would embark not upon an insurance business, but upon gambling. That is, of course I can say, pay me $10, and if something happens to you, I pay $100 out to you. But this guy would take a gamble. Only if he has 10 others, all paying the premium, and it is only 1 in 10 to whom this event occurs, is this an insurance business? Is this not a lottery, so to speak? Insurance, whether conducted according to business principles or according to the principle of mutuality, requires the insurance of a whole class or what can be reasonably considered as such. The characteristic mark of insurance is that it deals with the whole class of events. As we pretend to know everything about the behavior of the whole class, there seems to be no specific risk involved in the conduct of the business. So what you see here is you have to know the likelihood of a certain event for the class class as a whole. 1 in 10, in 1 of 10 cases, such and such will occur. You do not know to whom it will occur, but you have to have an entire group of people who insure themselves are pooled in the same group in order to be able to actually pay out to this one accidental event that requires payouts having to occur. To apply now to some cases, so I assume to know everything based on objective long-run frequency distributions, let's say, about hurricane damage in a certain, to the residents of in a certain area. But about any particular individual and his particular risk, I do know absolutely nothing except that he is a member of this group, and for the group as a whole, I can assess the risk of hurricane damage of certain sizes occurring. Now, in what you note in this definition of, in what Mises calls class probability, you notice that again there is noticeable the absence of any systematic income redistribution. No one knows who will win and who will lose. Also, in this case that I just cited, with 10 people paying $10 and one getting paid out $100. Nobody knows who will be the lucky one, and who will be the non-lucky ones. I know nothing about any particular person's risk except that he's a member of a group with such and such a group risk, and then all redistribution of income must be, by definition, random. It is unpredictable. Nobody knows in advance who will gain and who will lose. And this also implies, so to speak, that we refer to these individual cases that are grouped together, that from our point of view they are homogeneous. We cannot tell the difference from one case to the other. The accident is, so to speak, accidental. So we reach, as a first temporary conclusion, insight that we can only insure ourselves against risks that have the character of accidents. Something that cannot be predicted in individual cases, but can be predicted only for groups as a whole. Now, what follows from this then, as far as uninsurable contingencies, uninsurable surprises are concerned? All events for which we can say, I know, with regard to a particular risk, my risk, your risk, his risk, some of the things that influence the particular risk, whenever we are in such a position where we know something about individual risks, those things cannot be insured. It is impossible to build groups. the group is then only a group of one. I know something about this particular instance. In this case, if I know something about a particular instance that makes the likelihood of a certain event higher or lower, then this falls into the realm of individual responsibility. Then I have to take care of it myself. I cannot take out insurance and cover myself in this way. Now, what type of risks are of this kind where we know something about individual risks rather than group risks? Those are all events or contingencies that individuals through their individual action can affect, can influence. If I have the slightest influence over the outcome or not outcome of certain events, then such a thing is not insurable. We give you some examples of this. We do have control over our own actions. Because of this, every risk that may be influenced by my own actions is, strictly speaking, uninsurable. I'm not saying that insurance companies currently adhere to this principle, as we will see in a little while. If something that was not controllable does become controllable by individual choices, by individual actions, then it stops being an insurable event. Now, with respect to risks of the type of natural disasters, for instance, floods, hurricanes, earthquakes, fires, insurance is possible. Those have the character of accidents. That is, we do not bring them about by our choices. We have no influence whether they will occur or not occur, whether we will be hit by them or not hit by them. I know nothing about my individual risk except that I'm a member of a certain group of individuals, which as a group is affected by an objective risk frequency. On the other hand, take risks like suicide. Can I insure myself against suicide? Could an insurance company insure such an event? And the answer is no, this is not possible because of course I have influence whether I kill myself or not. What would happen to an insurance company that would insure people against contingencies such as this? They would attract, of course, all suicide candidates, and they kill themselves, and then the wives or children, whatever, get millions of dollars paid out. An insurance company that would abstain from such a thing would instantly outcompete them. This is not an insurable event. Take an event like you can insure yourself against your house burning down by accident. But can you insure yourself against the risk of you yourself burning your house down? And then after you paid your premium, then going and say, okay, build me a new house, I just burned it down. That is not an insurable event. Because in this case, I have full control over whether this event will happen or not. Take an event like unemployment. Now you realize we have something that is called unemployment insurance. But the fact that certain words are used in certain cases does not mean that is what it says it is. Is unemployment an insurable event? The answer is, of course it is not an insurable event because I have, of course, complete control over whether I'm employed or unemployed. If I go and kick my boss in his behind and lose my job, and then I collect unemployment, this is not an insurable event. I can always accept, so to speak, a lower wage. If they tell me we have to just dismiss you, and I'm thinking, then I can say, yes, of course, I work for less. But if I'm not willing to work for less, then I will be unemployed. It is not an insurable event unless Unless we say the insurance company then has the right immediately to assign you to a certain task. Once you say, I'm unemployed, and then they tell you, but now you do such and we will pay you such and such amount for doing this sort of stuff. But simply saying, unemployed, I'm unemployed, unemployment is not an accident. It is not anything about which you have no control whatsoever. Very brief. Also not insurable. I'll come back to that in a second. Over those things, people have also control. They can, of course, then also work for a penny. Something like this. For instance, here, my next example just deals exactly with this. Can I insure myself against making business losses? Can I go to a company and say, insurance company say, look, I know business losses can occur, just to be sure that I'm not in dire straits once they occur, I want to take out insurance against making business losses. The answer should be perfectly clear. No insurance company could ever do anything like this because you can make deliberate losses. It's like I produce a lousy product or I mistreat my consumers, then I make losses, or I'm just plain stupid and make losses. Then I cannot go to the insurance company and say, look, everybody can make losses. This is just an accident that happened to me, just like being struck by lightning. And please now pay out. After all, I did pay a premium last month. So that cannot be done. So I would never be in a position where I can say, I know nothing about my personal loss risk, except that I, as all other businessmen, are faced by the same group loss risk. So as if a loss were something like being struck by lightning. That is not possible. Fractional reserve banking. You have probably heard about that too. I will hear about this in other lectures. Banks have take deposits. You have the right to redeem your money at any time you want. But the banks print up additional tickets covered by nothing. Now, can you insure yourself against bank runs resulting from the practice of fractional reserve banking? And the answer is that's absolutely impossible, because I can, of course, make sure that a bank run is occurring. If my reserves are zero, then definitely a bank run will occur. That is, the higher my reserves are, the less likely is a bank run. The lower they are, the more likely is a bank run. I have, so to speak, perfect control over a bank run occurring or not occurring. If I have 100% reserves as a deposit bank, no bank run can occur. If I have less than 100% reserves, then of course bank runs can occur. There is federal deposit insurance, as you know. Yeah, but the same reason for this exists as we have unemployment insurance. Insurance sounds good, but it has nothing to do with insurance. Why can something like this be offered? That is, whatever, even if you up to $100,000 or whatever the amount is, banks are allegedly insured. If you are allegedly insured up to $100,000, then your incentive is to have no reserves whatsoever. And if a bank run occurs, this can only be dealt with not because there is an insurance company doing this, but there is a government ready with unlimited power to simply print up the necessary money. If that would not exist, no insurance would ever take on a risk like this. This has nothing to do with insurance whatsoever. It is just a euphemism for a fraudulent scheme that exists in this case. Very quickly.
Suppose I know that everyone lives their life for some $100, so I often suicide $100, knowing that even though they control over that, they have no incentive themselves and claim $100.
Yeah, but you have to know this. You have to know that every person is like this.
I mean, that's obvious to me.
No.
I would be quite happy to suicide insurance for that amount. If everyone in this room knowing it's virtually values their life so little.
Because again, you assume that all people are the same, that their risk is homogeneous, but that is not the case. There are many people for whom that is not worth $100, and it would not work then. So again, you make the assumption all people are the same, that they value their life more than they value $100. Yeah, that might be, but might not be. And people do have, so to speak, the ability to influence this risk. That is, to say, I do it for 90, I do it for 110, for 120, and so forth. So it is not an objective, long-run probability distribution that you have that would allow you to do anything like this. Again, let me just delay questions for a moment, otherwise I will never get through my my stuff here. Can we insure ourselves against the risk of not feeling good in the morning and getting out of bed? The same thing. I mean, if I insure myself against this, I will never get out of bed. On the other hand, of course, I do have perfect control over whether I will get out of it or not. What that gets me to is to say that as far as health insurance is concerned, there exist very, very few things in the realm of health against which people could be, strictly speaking, insuring themselves. Because there are very, very few things that have, strictly speaking, accidental characters and over which we have no personal control. Most of the health risks, except, of course, catastrophic accident and so forth, most of the health risks can be influenced by individual choices. This is hardly ever discussed in the current debate about health insurance. That there are very, very few things that fulfill the characteristics of accidents striking certain groups, and most of the health risks, so to speak, are risks about which people have full or partial individual control, and because of this fall into the realm of individual responsibility. One of the very few people who has recognized this is Mises. Let me just read you some quote from his book Socialism, published in 1922, before all of this stuff became really popular topics. There he says, to the intellectual champions of social insurance and to the politicians and statesmen who enacted it, illness and health appeared as two conditions of the human body, sharply separated from each other and always recognizable without difficulty or doubt. Any doctor could diagnose the characteristic of health, and illness was a bodily phenomenon which showed itself independent of the human will and was not susceptible to influence by will. Now, every statement in this theory is false. There is no clearly defined frontier between health and illness. Being ill is not a phenomenon independent of conscious will and of psychic forces working in the subconscious. A man's efficiency is not merely the result of his physical condition. It depends largely on his mind and will. Thus, the whole idea of being able to separate by medical examination the unfit from the fit and from the malingerers, and those able to work from those unable to work, proves to be untenable. Those who believed that accident and health insurance could be based on completely effective means of ascertaining illnesses and injuries and their consequences were very much mistaken. The destructionist aspect of accident and health insurance lies above all in the fact that such institutions promote accidents and illness, hinder recovery, and very often create, or at least intensify and lengthen, the functional disorders which follow illness or accidents. Just compare the likelihood of self-employed people being ill and incapable of working with people who are employed and are insured as employees. Self-employed people work under conditions that would be considered unbearable by most people who are employed and have insurance. It is in health insurance in these types of things actually creates illness, laziness, malingering, and so forth, and it creates it precisely because these types of events are not insurable from the very outset. So what we would expect in a free market is that most health risks are assumed individually, that is, and paid out of individual savings, and that insurance would be limited to the accident variety of risks, that is, to foreign-induced damage, with strictly limited coverage, no coverage, of course, of newly discovered risks, and precisely specified payments, generally in the form of indemnity, that is, cash payments, and sometimes in the form of in-kind services. Now, I have to move quickly here. I'm too late. Now, if you look at the current world, then you find, of course, that the current world has very little to do with what we would expect to exist in the free market. In the current world, we have numerous uninsurable risks that are covered by insurances, and we have many misgroupings of people going on that would immediately disappear in the free market. That is, yielding a systematic, predictable income redistribution from lower to higher risk groups. Coverage is frequently undefined and is open-ended, and payments or service amounts are likewise unspecified. Now, what is the reason for this? The reason for this is insurance regulations. In order to operate insurance companies have to fulfill certain criteria. Otherwise, they simply cannot open shop. I want to give you a rough overview over some of the crazy insurance regulations that exist that force insurance companies to cover things that are uninsurable, strictly uninsurable, and to misgroup people. For instance, state mandates require, and the numbers are from 1991, so there are probably far more. There are close to 1,000 mandates imposed on insurance companies. Insurance companies are forced in almost all states in the United States, for instance, to cover alcoholism. Now, it should be perfectly clear that not every person is as likely to be affected by alcoholism as every other person. But nonetheless, all insurance companies must cover people who suffer from alcoholism. Obviously, it drives the premiums up. Forces people who are not affected by this sort of to pay for those who suffer from this sort of thing. Misgrouping. Drug addiction. In 27 states, probably in the meantime far higher, drug addiction must be covered by insurance companies. Chiropractors must be covered. Psychologists must be covered by 36. There are some people who never go to a shrink and will never go to a shrink. Nonetheless, the insurance companies must cover the cost of this also. And some people, of course, love to go to shrinks. And have to pay, of course, for those people who do. You have control over whether you want to go to a shrink, whether you feel you are shrinkable or non-shrinkable person. Social workers in 22 states, help by social workers has to be covered. In Illinois, liver transplants. In Georgia, heart transplants. Again, not all people are equally likely of being affected by heart diseases. There are subgroups. Some people are far more likely affected by others, but nonetheless, it covers all of them. Very nice. Hair pieces in Minnesota that would help people like Bob Murphy, for instance, who would not have much of an effect for me. Pastoral counseling in Vermont, sperm banking in Massachusetts. So if you feel like your sperms have to be spread around a little bit, then the cost of this will be covered in some places, and those people who keep the sperms for themselves or privately, they have to pay for other people who feel that the world needs more of them. No AIDS-related questions are allowed in many states, for instance. That is, an insurance company cannot ask what sort of lifestyle people lead, if they are intravenous drug users and so forth. In California, insurance companies cannot perform any genetic test to determine whether you belong into this group. All people are grouped together, despite the fact that they know full well that there are some people are affected by such and such, and some people are affected by such. There exists, for instance, sickle cell anemia that is more frequent with black men than with whites. Then there is this Tay-Sachs disease that occurs more frequently with Jews than with non-Jews, and so forth. So many types of information are available that would allow people to be grouped in different groups. Insurance companies are not allowed to do this, despite the fact that we know that they have different group risks. Now these mandates, which force insurance companies to cover things that are, strictly speaking, uninsurable, and to misgroup people, have, of course, a dramatic consequence. The consequence is that the prices of these things always go up. There's this systematic income redistribution, so to speak, from people who live healthy lifestyles, so to speak, to people who live unhealthy lifestyles, or people who belong to more dangerous groups. For people who belong to less dangerous groups, they support systematically people who have higher group risk. What is the consequence of this? The consequence of this is, of course, that many people decide, I don't want to be insured at all. Now you hear always this complaint, there are so and so many people who are not insured at all. What is never pointed out is, of course, that this is for many, many people a perfectly rational decision to take. If I take insurance, I have to have to pay for all sorts of risks that simply do not apply to me. Then at one point you say, I do without it entirely. And the most I do is just choose insurance for catastrophic events. That is, being hit by a car or falling off a cliff or something like this. So the fact that we have millions and millions of people uninsured is not exactly an economic catastrophe. It is, to a large extent, a perfectly rational decision on the part of the people who say, this is just too much. I cannot afford this sort of thing, given the fact that none of this applies to me. And what do they do then next? And here we have an example of like how one intervention leads to the next intervention. First, the government intervenes in the insurance market by insurance regulations. Then the prices go up. People drop out of it completely. Only the higher risks remain in the pool of people who are insured. The low risk people drop out of the insurance market entirely. So what do you do then? Then you make compulsory health insurance, which exists, of course, in many European countries. All people must be insured. So if all people must be insured, what is then the next problem that arises? Now, of course, prices will go up. And what is then the last thing that governments do? Then they begin rationing services. Then they distinguish between good diseases and bad diseases. People who do get treatment and people who don't get treatment. People who have to wait six years before they get treated against such and such, and other people who get preferential treatment for whatever disease they have. And you know, of course, what they do. They are politically correct diseases, so to speak, and they are politically incorrect diseases. Whatever. If you have some smoking-related type of disease, you can wait until you die. On the other hand, if you belong to some favorite groups, whatever, AIDS patients or something like this, then entire hospitals will be rolled out for you, and you will be treated on the spot. Everybody who knows anything about the British healthcare service or the Canadian healthcare service knows how that is, that people then have to just go, in order to get treatment at all, they have to just go to other countries in order to get the treatment. Because treatment, what sort of treatment you get, how the prices for various treatments are all government-regulated things rather than phenomena that are decided on the free market. Let me end by, again, reading you a quote from Mises, who, as in many, many cases, has seen all of these things long before anybody else has seen them. Here we have it. So Mises says, the psychic forces which are active in every living thing, including man, in the form of a will to health and a desire to work, are not independent of social surroundings. Certain circumstances strengthen them and others weaken them. The social environment of an African tribe living by hunting is decidedly calculated to stimulate these forces. The same is true of the quite different environment of the citizens of a capitalist society based on division of labor and on private property. On the other hand, a social order weakens these forces when it promises that if the individual's work is hindered by illness or the effects of a trauma, he shall live without work or with little work and suffer no consequence and suffer very noticeable reduction of his income. Matters are not so simple as they appear to the naive pathology of the army or prison doctor. Social insurance has thus made the neurosis of the insured a dangerous public disease. Should the institution be extended and developed, the disease will spread. No reform can be of any assistance. We cannot weaken or destroy the will to health without producing illness. And what we have currently is a system that systematically produces illness and disease by subsidizing it through insurance regulations. And this is what, under Obama and previously Clinton, you will get more of this type of crazy institutions that breed literally sickness instead of strengthening the will of people to be healthy and willing to lead productive lives. With this, I will end. I take one or two questions. Yeah.
Car insurance, every state that I know of, usually when people go off the road, it's fraud.
Yeah.
Is insurance fraud a fabrication of the whole fraudulent system that we have it? Would there be no insurance fraud in a market system so people actually don't have to fraud the system?
You see, that brings me back to the point. To the extent that you have an individual influence on the likelihood of the event, fraud is of course possible, right? So I can of course cause our car accidents intentionally. There are actually gangs that do this sort of stuff, arranging accidents and then having some special guy who fixes it and then billing the insurance companies for it. Car accidents are very often accidents. But it is not unimaginable that car accidents are fraudulently brought about. And to that extent, they are also not insurable events. So even in the case of car insurance, it is accident insurance, it is somewhat doubtful whether the current system would really prevail if it were left to the free market. Yeah. What? Yeah, I think if they insist on diligent searches and so forth, that means like you are guaranteed that the title is okay, right? Yes, I think that strikes me as likely being an insurable event, because the insurance company itself can take on the task of investigating whether the title is all right or not. In this sense, they could eliminate fraud, claims that are brought later after it is discovered that the title was not all right. Yeah.
If we had a free market banking system, we have a bank run insurance. Would that be possible if you deposit, if you're rich, you had $300,000 in the bank, you wanted to insure yourself because you don't really have any control?
No, there could be no bank run insurance, because bank runs you can bring about deliberately. Look. Let's take out, I pay my premium against a bank run. And then I lower my reserves to zero and loan everything out in order to earn interest. Right?
I'm talking about not the bank itself, but depositors. Depositors insurance. Depositors pay for the insurance, right?
Yeah, but A depositor goes to the insurance and just makes sure that the deposits are there?
Well, just in case the bank, well, it would have to get at the risk of the bank.
Yeah, but then this insurance company would do nothing else but go to the bank and see that the bank has 100% reserves. Right? You pay for the service. This is by and large nothing else but hiring a guy who makes sure that the bank has 100% reserves. Yeah. I'm not even so sure about that sort of stuff. It's like that they have to have assets, of course, outside of the earthquake region themselves. There would be different types of groupings necessary. People would have to pay different premiums depending on how the houses were built. Look for insurance against crime committed against your houses. If you have a safe at home, the premiums are lower than if you have no safe at home. If you have built your house to be resistant against earthquakes of a certain strength, you would have to pay a lower premium than people who have built some sort of cardboard houses. So all of this is, of course, also not done. I'm not saying that these insurances are actually operating according to strict insurance criteria. All I'm saying is it is imaginable that in those areas something like this might be possible. In those areas where individuals, through their own actions, have influence on the likelihood of a certain event, those things cannot be covered, strictly speaking, at all. It has to be some sort of it has to be an accident, the likelihood of which cannot be influenced by individual actions. Those things are insurable. Events over which we do have some control are, strictly speaking, not insurable. This does not mean that we can do nothing against these sorts of things. But what we must do against these things is to take even individual precautions. That is, have individual savings accumulated in order to prevent, in order to get out of these crisis situations. We have to stop. Sorry,